Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another of our double shot interviews, and I'm joined by Neil Roberts, who's the CEO and founder of HarMoney. Welcome in, Neil. Now, HarMoney is a company that is going to be applying to the Financial Markets Authority to be a peer-to-peer lender. So we're here to talk about peer-to-peer lending. And now, peer-to-peer lending, it's obviously new for New Zealand. So I guess let's start at the real basics. I mean, what is peer-to-peer lending? Yeah, well, in essence, it's a very, very simple concept. It's an automated platform that facilitates borrowers and people who want to borrow and people that want to lend to transact with each other. And in doing so, cut out the banks. What it does is it opens up a new asset class for investment purposes, and for the first time, retail investors can access the gross retail rates that are available. So, how will borrowers and lenders be matched? Okay, well, firstly, obviously the platform has a full application set for borrowers. So people will be ID'd, in the case of HarMoney, we have a fully automated online, ID, which involves a face scan, together live date stamped face scan and scan of the ID. So firstly, people are identified as they are who they say they are. Then they go through a whole application process that you typically expect, that any bank would do, that's assessing them for character in terms of will they repay, and then capacity, can they afford to repay. So we go to the major bureaus. It's our view that you need local experience. We have the benefit that we started a credit environment in 2001. We put $3 billion of applications through in personal loans, of which about $1.5 billion was written business. We actually processed the business. So over that 5-year period, we learned an awful lot, and we've built a bespoke credit scorecard. We've then not only built it, we've improved it 2 or 3 times in the last 6 months. We've been working hard on it. And then we've got we will get 2, but we've got an external endorsement of that scorecard from Dun & Bradstreet, and we've checked it with independent data as well. So that, in essence, makes sure that the borrowers are prime, and that they can afford to repay the loan. So then they go into a marketplace. On the lender side, obviously we need to do identification checks and comply with the relevant legislation, particularly around AML, anti-money laundering. But once we've done that, and the lender has credited, obviously read the disclosures, understands exactly what they're getting into. Once that's happened, then they credit their account, and then they can in essence invest in the person, if you like, or in the loan of that person, and get the retail type rates. Now, importantly, we believe that to spread the risk, to help spread the risk, and truly be able to give a known result, because there will be credit losses for sure. That's intrinsic in the actual product. So in order to spread the risk, we break down loans to $25 lots. So if a borrower applies for $10,000, we'll break that down to $25 lots, and we encourage people to take a huge spread of their risk. So if any one loan does get into trouble, it's only a very small part of the overall portfolio. Now, in doing so, we're able to produce retail results net of all costs and net of a predicted credit loss that is in the double digits on average. That's in terms of interest rates paid to lenders? Paid to lenders after costs and after credit losses are taken account of, yeah. Okay, so in terms of how you're going to price these interest rates? Yes, to borrowers? I guess to both, okay. to borrowers, yep. And to lenders. Sure. Yep. How's that going to work? Okay, so we use our credit scorecard. The reason it's so important in this environment is, the benefit that the platform provides, or one of them, is to be able to put risk in a grading system. We have 30 grades. They start with letter groups, and in terms of approved loans, you might have A, down to G. And obviously A being, absolute gold brick benchmark, not a lot of volume in A, but you don't expect much loss either. Down to those that are still prime, prime customers. It's not payday, it's not people that can't afford to pay you back, but they are on the surface of it. They contain more risk, if you like. And then it's a wonderfully transparent system, and because you get to see, if you want to, you get to see the loans, you get to see the application, you get to see the credit file. The only thing you don't see, in fact, is anything that can identify the borrower, because that's sacrosanct, the identity of the borrower. And you pick which loans that you want to invest in. And, I can certainly speak for HarMoney in so much as, the platform, although it facilitates the transaction, the money transfer, that's about as far as we get involved in handling the money. What we do is obviously we underwrite risk. It's very important, we believe, that there's experience set of the team. And then we make sure we collect on it appropriately, and we run a bank grade, secure, global platform where we partner with Force.com, who, to give you an idea, spent $1.2 billion on security, and no bank or no financial institution could come close to the investment that Force have put in their platform.
So you noted that, of course, there will be credit losses.
Yes.
Borrowers defaulting.
Absolutely.
What are you going to do when that happens?
Okay, well, firstly, what do we do before it happens? I think is really, really important. I've described some of that. We have it's myself and some of the other team that did create that scorecard back in 2001. We do have the benefit of $3 billion in applications gone through. So I think, firstly, you need that experience set. You need that scorecard in order to be able to predict loss properly. Just as we've done for the last 14 years together, we've created a benchmark collections process that we believe are better than any bank, fully utilise the automation available on the platform, and we will collect in a very similar fashion that we have done in the past. So that's all available to us. That does not change.
So will you have internal debt collection, or will you outsource that?
It's for HarMoney, our belief is that we can get the best of all worlds by actually having a panel. So in our experience set, what we found is if people, entities that outsource, a collections business is very simple. They will go to the easiest thing to collect on because they're trying to get a return on their operational expense. So the way that you do this is you pick a panel. In our case, we'll have two. Plus, we'll have a champion challenge. We'll have the best collectors, small, but the best collectors internally as well. And that champion challenge sets the standard, firstly, and secondly, we'll move business to those that are getting the best result for our lenders. Absolutely.
And the sorts of loans you're going to look to do, we're talking personal loans. So, for example, if I wanted to buy a car and wanted to borrow money for that type of loan.
Yes.
What about debt consolidation loans and small business loans? Is that something that's on the agenda too?
Sure. So the good thing about starting with personal loans, everyone understands it. Personal loans have been written for 100 years, pretty much for the same purposes, and written by the main high street banks predominantly. So that's the good part about choosing personal loans. So we will do exactly what we did in the 1.5 billion that we actually processed in the startup we had here and beyond over in Australia, which is predominantly debt consolidation's a very big part of the business, and mainly it's getting rid of very expensive credit card debt where people are paying off minimum payments and they've got that credit card debt for a very long time. So it's bank grade customers. It's just people that run up a bit of debt and they want the simple benefit of being able to pay that off in fixed instalments and knowing that they'll get to a point and they have no debt. And if you look at the credit card market and personal loan market, and you look at the banks, because this is a competitive play against the banks on both sides of the equation. The big four are the most profitable in the world. I know that Interest.co have been, have recognised that in past articles. Now, within the most profitable banks on the planet, the most profitable categories are credit cards are number one and personal loans are number two. In fact, in our own assessment, credit cards are 12 times more profitable than the rest of the bank, and personal loans are 10 times. So the beauty about personal loans is we're attacking a very profitable part of the bank's business, but yet it's a very simple product that has produced a result for the banks that's near riskless because it's so predictable over 100 years. Yeah.
Now, the banks here have something along the lines of about $108 billion in term deposits.
Growing fast.
And continuing to grow.
Yeah, indeed.
Clearly that's a market that you're targeting in terms of your investors or the people who will lend money to your borrowers.
Yes.
You've talked about on your website, it notes, interest rates of 9%. You're talking double digit in some cases as well.
Yep.
How are you guys going to be able to afford to pay interest rates that are so much higher than those term deposit rates are at the moment?
Okay, so it's a very good question. When we look at New Zealand, which is a small economy, you have, to get a fixed term, fixed rate income product, where do you look? And we don't have the stock market that withstands dividend stocks. And in terms of the banks, the banks compete with the other banks. The big four are protected by the 4-pillar policy. They can't be bought nor by each other. And of course, history would say that if they get any decent competition, then they have the scale to just buy them. And that's happened 12 times materially over here in New Zealand and in Australia. So what's the competition there in terms of the returns that savers get? And we don't believe that there's competition at all in that market. So that's the foundation. How do we do it? We're simply a platform that introduces lenders to borrowers, and the lenders are enjoying the full retail rate. So there's no one in the middle. There's no bank in the middle taking that margin, which is exactly what happens if people put their money on term deposit. The bank takes the risk, whereas in our case, obviously, the lender takes the risk. But we believe that it's a predictable risk. It must be, because the banks have done it, and it's such a profitable line of business for them. And it's simply that. They're enjoying the full retail return. For the first time, we have a fixed term, fixed interest product where we're opened up to retail investors the retail rate. So, yeah.
And obviously your costs will be much lower than banks and even finance companies as well.
Yeah, you see, the beauty about peer-to-peer, the model, the elegance of it, is there's no inherent leverage. So we're not loaded up with debt, unlike a bank. The bank might put 10 cents on every dollar in terms of their own money. The rest is borrowings. So there's none in a peer-to-peer environment. So that helps with cost. Then we've got no branch network. We're fully automated. We're fully automated with good support behind it, because you do need that in this business. But it's 24/7. And our costs are a fraction. In fact, we believe the banks can't compete and can't get close to our cost base. Yeah.
So how are you going to make money?
Sure. We've studied the platforms around the world, and there are a couple of different models, but they're relatively simple. Firstly, it's transparent. So all our pricing will be online. So you'll be able to see exactly what we earn, and there's nothing hidden, and you get to see that and choose, whether you want to transact, before doing so. Secondly, so the money's earned in two ways. There's a small monthly percentage of the repayments that we take from lenders, but it is small. And from borrowers, we take an origination fee. Now that origination fee varies depending on the credit risk, because it is materially harder as you go down the risk grades. But yes, it's a small percentage up front paid by the borrowers, and we're able to do this and offer these great rates, and borrowers will get a better deal than they do currently from the banks, and obviously it's considerably higher for lenders.
So there'll be basically one fee charged against the borrower and one against the lender.
Yeah, so one upfront origination fee from the borrower, and then from the lender is a small monthly fee as that loan.
Can you give us any indication of the size of these fees, roughly? What do you think they might be?
I think they might be on average. So on average, the origination fee, if you look at, let's talk about, if you don't mind, because we are going through the application process right now, but I can talk about, Lending Club, where you'd say the average is about, 4% charge flat to the borrower up front. So what would that be? 10 grand loan is $400. And then on the other side, it's 1% taken from the repayments that are made each month, which works out at about 0.5% per annum on the amount you have invested. So, these businesses aren't, they're low margin, but they're low capital and they're low operational cost. But it's obviously important to get volume, that's certainly where we'll be targeting that market for sure.
Look, it sounds like a really interesting business model, lots of potential.
Absolutely.
I'm interested that the FMA is only anticipating 4 license applications, obviously one of which is you guys.
Yes.
What sort of reaction or response are you anticipating from the banks and some of the smaller finance companies who are in that personal lending space as well? I mean, how are they going to react to all this?
Well, certainly we thought about the banks an awful lot. So if you're, obviously, as we've talked about, the 4 banks are protected. It's a $20 trillion economy. They have massive scale. And you commented on it quite right. I think it might even be 114 million, isn't it, on deposit now. It is growing. And, that's New Zealanders are putting up with that, that 3%. We thought about it a lot. How will the banks react? I think we saw that there was the very first bank reaction was to actually Westpac bought in to an existing peer-to-peer platform, not in New Zealand but overseas. So that was the first move, and that actually was followed by Barclays and I think Santander, I think is the bank over in Spain. Yeah, so 3 banks all in a week, because I think they're starting to see the competitive pressure and the fact they can't compete. So if you can't compete and you're huge, what you do, you buy in. So I think that if you're one of the major banks and you've got a massive amount of cash on deposit now, are you really going to go and you're going to offer rates that are 3 or 4 or even more at times the return? I mean, that's a straight loss for you. So I think the banks have, since the Westpac purchase, they have got to grips with the model. They understand. They're watching it very, very closely. I know that for a fact. So, but I don't think they can make a move. I don't think that they are able to directly compete because it would cost them so much, and they'd have to recognise the fact to the New Zealand public that that the rates they've been paying are kind of low.
Will banks be allowed to partake through your platform? Like, can they lend money through peer-to-peer lending platforms? Is that something you're looking at doing at HarMoney?
So banks, so institutional funding, so it can be, the regulations do allow for institutional funding, and there will be some institutional funding, I'm sure. What we're really interested in HarMoney is, most New Zealanders have exposure to the credit markets, but it's usually through a super scheme, and it's usually on the wholesale side. So, very well secured, admittedly, but very low returns. So we're interested in opening up this new asset class to direct to institutions rather than, and again, going around the banks. Will the banks get involved? I mean, my view is that they might hesitate initially. Certainly, experiences overseas, like why empower something that could be highly competitive? But as the system has proven up, and it's great technology. In my view, for HarMoney, better than any bank, in terms of, the security grade and the way that it operates. It's got national reach, it's 24/7, and, if we get that momentum going, that volume going, then I think the banks will want to come on board, but they won't do it initially, I don't think.
What about KiwiSaver providers?
Yeah, so KiwiSaver providers, that's interesting. Again, probably not initially. Or if it is initially, it would be a smaller amount. But certainly that's something that's highly attractive, to us, of course. And for the future, you look overseas, the lending club is 40% of its pure retail investors. They're funding. They'll do $4 billion, if not more, actually, this year coming. They were probably the first and probably most successful peer-to-peer lending operation in the world. And Google have made an investment in lending company. That's Google Corporate rather than the Google Ventures, and they're working together on products. So we've watched that model very, very closely. In fact, we're over in San Francisco. We've been asked to present in the worldwide conference over there on credit. And we're catching up with Renau, and we'll probably find out a little bit more about what Lending Club, Renau's the CEO of Lending Club, are up to. But when we watch that model, we'll expect, just like the US and the UK, that retirement savings will come in time as we've proven up the platform.
Now, if we talk a bit more broadly, picking up on from what you're saying there on, I guess, what we've seen from peer-to-peer lenders elsewhere in the world, obviously the US and Britain are probably the two key markets where we've seen this develop. Australia and New Zealand coming into it now.
Absolutely.
I mean, obviously, peer-to-peer lending has sort of emerged in a period of historically very low interest rates.
Absolutely.
Sort of 2007, I think, in the US it kicked off.
Yeah.
How's it going to go? I guess in an environment where interest rates return to normal levels and perhaps even high levels.
You get higher than average. I think peer-to-peer lending is robust. I mean, it's controlled two ways by the marketplace that's outside of peer-to-peer as well as peer-to-peer itself. And I think that what you'll find is banks have been a little bit slow as the interest rates came down to pass on that savings, particularly the big four banks in New Zealand and Australia. When it comes to, I'm not talking mortgages here, but when it comes to personal loans and credit cards, you find that the 20% or just shy of 20% you pay on a personal loan in New Zealand was the same, in higher interest rate environments. So the rest has gone to profit. So I think that naturally, rates as they go up, borrowers will pay more because that's the marketplace. So I think that peer-to-peer will withstand the test of time, as long as obviously, as I mentioned before, the team are important, the credit underwriting is very important, and the fractionalisation, so breaking that 10 grand down into smaller lots, is essential to be successful, I think, in peer-to-peer lending.
Obviously, you're poised to put in your licence application to the FMA, assuming that is successful. Where do you see, I guess, firstly, HarMoney and also peer-to-peer lending in New Zealand in, say, 5 years from now? Ultimately, where would you like to see it?
We have a very clear vision in mind, and it goes back to that comment I made earlier in terms of where do New Zealanders, particularly as you get a little older, or if you're saving for a specific event, buying a house in Auckland, having a baby, any of those big life events, or you're getting to a point where you're nearing retirement. I think that we need I'd love to see peer-to-peer and HarMoney be at the heart of it, of course, as a alternative asset class that's mainstream. Now, you wouldn't be putting all of your investments or all your retirement money into peer-to-peer, but you'd be putting an element of it. And you'd be doing so, either as an active investor. I mean, we looked overseas, there are people that spend many hours picking the loans, and that's the way they prefer to trade. Or alternatively, you're investing as 2 clicks and you're invested for a certain return. Either or, I think the vision is certainly to be a part of New Zealanders' savings and, keep the banks honest, because, we can start with personal loans, but there are certainly opportunities, down the track. As you've seen with Lending Club going firmly into the SME market.
Well, thanks a lot for that, Neil.
Thank you.
That's Neil Roberts, who's the CEO of HarMoney, and I'm Gareth Vaughan at interest.co.nz.